If you think the next strike on homeowners will arrive with a giant flashing label that says equity tax, you are already one move behind. Government almost never begins by taxing what it cannot see. It begins by taxing what it can measure, what it can moralize, and what it can sell as fairness. That is why I want you to look at home equity differently. Now, most people still think property tax is a tax on owning a house. They are wrong. It is already a tax on a government estimate of value. Once you understand that, the next step becomes obvious. If a political system gets comfortable taxing higher income, then taxing higher net worth, then taxing unrealized appreciation, the distance between that logic and the equity in your home is not very far at all. That is the first mechanism. I call it the staircase tax. It always climbs in the same direction. First they say they only want more from people who earn a lot. Then they say they only want more from people who own a lot. Then they say it is unfair that certain pools of wealth sit there untapped while budgets strain. Income was step 1. Net worth is step 2. Home equity is the cleanest step 3 they could ever ask for. Why do I say cleanest? Because home equity is visible wealth. It is local wealth. It is politically easy wealth. It does not move quickly. It does not hire lobbyists. It does not vanish into a Cayman structure overnight. It sits on a parcel number with an assessor's file and a mailing address attached to it. That is the second mechanism. I call it the visibility premium. People talk about home equity as though it were private. In practice, much of it is already halfway public. Your county already has an assessed value. In many places, that value is refreshed regularly. In many places, the machinery that supports those assessments is getting better, faster, and more aggressive. The state does not need to guess whether your house is worth more than it was 5 years ago. It has a model for that. In some markets, it has aerial imagery, permit data, neighborhood comps, and software that never gets tired and never forgets your address. Now do the simple subtraction. Estimated property value minus visible debt equals a rough version of equity. That is all the architecture they need to start the conversation. Most people make the mistake of thinking the danger begins when a new law passes. It does not. It begins when the logic becomes socially acceptable. By the time the bill has a name, the language has already been tested. By the time it gets a vote, the moral argument has already been framed. By the time the press covers it honestly, the people who live by structure, not headlines, have already moved. That is the third mechanism. I call it the date trap. Taxes like this do not really hurt you on the day they pass. They hurt you on the date they measure from. That is what almost nobody understands. A bad rule can look forward on paper and still reach backward in practice if it uses a valuation date, an ownership date, a residency date, or an assessment date you did not know mattered. That is why prepared people act before certainty. The amateur waits for the professional acts when the direction is clear enough. I have watched that difference make fortunes and erase them. You do not need to be a billionaire for any of this to matter. In fact, the most dangerous phrase in finance is "this does not apply to me yet." That is how people stay still while the staircase tax climbs toward them, one landing at a time. A politician never begins with your house in the speech. He begins with fairness. He begins with the ultra-rich. He begins with somebody the room does not feel sorry for. Then he normalizes the principle that owning appreciated wealth is a taxable privilege, not simply a balance sheet fact. Once that principle is accepted, the rest is an engineering problem, and your house is easy to engineer around because you already trained the state to look at it every year. That leads to the fourth mechanism. I call it the dead equity trap. A paid-off home feels safe. Emotionally, I understand it. Mathematically, in the wrong political climate, it is a giant visible pile of untaxed, unproductive, easily measured wealth. It is clean. It is obvious. It is sitting there with no offsetting debt attached to it. The owner feels proud. The tax designer sees inventory. That is the uncomfortable truth. The family that spent 20 years rushing to kill every last dollar of mortgage debt may wake up feeling virtuous and still discover they have built the cleanest taxable target on the block. I am not telling you debt is always good. Stupid debt is stupid debt. What I am telling you is that structure matters more than pride. An asset with strategic debt attached to it is a different animal from an asset sitting in your personal name with no friction and no defense. And that brings me to the fifth mechanism. I call it assessor's fiction. The government's number is not the real number. It is the number nobody challenged. That distinction matters enormously. If your assessed value is high and you do nothing, that inflated number can quietly become the base for not just your current property tax, but for any future framework built on top of it. Most owners do not protest. Most owners do not assemble comparables. Most owners do not inspect the record for errors. Most owners assume the county's math is the market's truth. That is laziness disguised as trust. If you own meaningful equity, you should treat that assessment the way a business owner treats an aggressive invoice. Read it, test it, challenge it when it is wrong. A lower base today is not just a smaller bill today, it is a smaller launching pad for tomorrow's bill. Some owners have another shield and do not even know it. Homestead caps, assessment limitations, and similar protections are not glamorous. They are boring. That is exactly why they matter. Boring protections are usually the ones that save people. If your state gives you a legal speed limit on how fast assessed value can rise, and you never activated it, or you let the paperwork lapse, you handed away free protection. That is foolish. The sixth mechanism is the name link trap. People underestimate how much of taxation is just database matching. Name, address, parcel, estimated value, mortgage filing, mailing address. That is how first sweeps get built. So if you ask me whether title structure matters, my answer is yes, but only when done properly and only with competent legal guidance. I would speak with a trust and real estate attorney before I touched a deed. Not after before a properly thought, through trust, LLC structure, or layered holding arrangement does not make you invisible. Do not be childish about it. But it can make you less simple, less immediate, less first, pass obvious. In tax and asset protection, complexity is often not the whole defense, but it buys time, and time is a form of defense. Do not confuse this with pretending. If you are going to move, really move, do not play games with residency. States that care about revenue can be shockingly aggressive when they believe you left only on paper. Your life leaves a trail. Phones leave a trail. Toll records leave a trail. Doctors leave a trail. Veterinarians leave a trail. Your dog can ruin a fake move faster than your accountant can fix it. The rich people who stay rich understand something most people miss. They do not just chase lower taxes. They chase jurisdictions that are slower to improvise new ways to define taxable wealth. That is a different mindset. Now let us talk about the move that makes people uncomfortable, because it sounds backwards. Extracting equity is not automatically reckless. Used stupidly, it is reckless. Used deliberately, it can be strategic. If home equity becomes an ever more visible tax target, then unused borrowing capacity against that equity is not merely a financing tool. It is optionality. A HELOC you never draw is still optionality. A line in place before fear spreads is different from begging for access after banks tighten. Structure created in calm weather behaves differently from structure built in a storm. Again, I would not touch that question without running it through a CPA and a competent attorney, because the goal is not to play clever games. The goal is to stop being easy to map, easy to bill, and easy to squeeze. There is a broader principle here. The tax code is usually toughest on static wealth held plainly and passively in a personal name, and often more flexible toward wealth that is embedded in productive systems, carried with debt, shielded by depreciation, or held inside entities with legitimate business purpose. That is why I say the game is not just to own. The game is to own in the right form. If you leave equity sitting in a primary residence with no income attached to it, no strategic debt against it, no defensive structure around it, no challenge to the assessment, and no planning around domicile, you are not merely owning an asset. You are volunteering to become easy math. And politicians love easy math. They do not have to understand your life. They only need a formula: assessed value minus debt equals taxable capacity. That is the temptation. Now, I want to be very precise about one thing. I am not saying a national home equity tax arrives tomorrow morning. I am saying the intellectual and political path toward taxing unrealized wealth has become much more open than it was a few years ago. And if that path opens wider, primary residence equity is too obvious to ignore forever. That is the adult version of this conversation, not panic preparation. The same people who tell you not to worry are usually the same people who assume you will have time to react later. History is not kind to people who assume later. Later is where taxes become facts. Earlier is where defenses get built. So what would I do if I owned a lot of equity and wanted to stop being lazy about it? I would do 6 things. I would study my state and ask whether it is moving toward more aggressive taxation of high earners, capital, property, or wealth. I would make sure every homestead or assessment protection available to me was active and documented. I would challenge any inflated assessed value instead of treating it like gospel. I would sit with a real attorney and review whether title, trust, or entity structure makes sense for my exact facts. I would think very carefully about whether dead equity should remain dead. And if I were serious about changing domicile, I would act like a grown-up and move in a way that could survive an audit, not a cocktail party conversation. That is not excitement. That is discipline. People love dramatic wealth stories because they imagine danger arrives as a siren. It usually arrives as paperwork, a new line on a bill, a new definition in a statute, a new threshold, a new valuation date, a new assumption about what kind of wealth is fair game. That is how this thing moves. Quietly, then suddenly, if you build equity by following the rules, understand the lesson. Following the old rules is not enough. Once the people writing the new rules change what counts as visible wealth. Your home is not just where you live. To a hungry state, it is a ledger entry with grass around it. And if you do nothing, you are giving them the easiest version of you to tax. I would not do that. I would get smaller. I would get sharper on my paperwork. I would get serious about structure. And I would do it before the slogan changes from tax the rich to tax idle equity. Because once the principle is accepted, the rest is arithmetic, and arithmetic is merciless.